Welcome everybody. I'm here with Alastair McQuater, the head of corporate tax at Buzzacott. We're here talking about capital gains tax in light of the Office for Tax Simplification's paper that came out last week, which is endeavouring to try and simplify, believe it or not, capital gains tax. So what we're going to cover, we're just going to cover why are we here and now talking about this lovely paper from the OTS. We're going to talk about what problem they're going to try and solve. We're going to talk about how it might affect entrepreneurs and what reliefs might be available for them. We're going to talk about how it might affect share schemes, and then we're just going to have a bit of a wrap up. And Alice is going to get his crystal ball out and tell us exactly what's going to happen come next March. No pressure there, Alastair, at all. Anyway, hope you look forward to and enjoy the next 20 minutes, half an hour. You might not need to watch it all if you don't want to. You could probably jump straight to the bit you're interested in. So sit back and enjoy. So just kicking off, who are the Office for Tax Simplification, Alastair, and so why are we here now with a paper released by them?
So the Office for Tax Simplification was set up in 2010 to offer advice on simplifying the tax system. It really is as simple as it sounds. They've been a statutory body now for 4 years, and this is probably and inheritance tax, the two meatiest projects they've got into over their lifetime. But they seem to be expanding their range.
Excellent. And specifically capital gains tax, why is that been put on the agenda?
Well, I think it's on the agenda because we're going through the pandemic. We've borrowed a great deal of money, and there's going to be a need to balance the books at some point. Capital gains tax is one thing that is looked at fairly regularly. It's also a tax which is popular with a large part of the electorate, mostly because they don't pay it. So it's an easy thing for government to talk about raising, rather than income tax or other taxes where everybody else pays them.
So, Alastair, what is the problem that the Office for Tax Simplification are trying to solve with regard to capital gains tax?
Well, for one, I'm not entirely sure that they know. They were asked by the Chancellor to go away and come up with recommendations for capital gains tax, which is slightly different from their normal approach. Their report focuses really on simplification and also bringing whether income tax and capital gains tax should be brought into line.
And is that something that the government have been pushing for?
I'm not sure that government is pushing for it, but I think it fits with an agenda that has run through politics recently. There is a need to raise money, and there is a great deal of noise in the press at the moment that capital gains tax is ripe for reform, that it's not fair. I think one goes back to Warren Buffett and his comment about him paying less tax than the whole of his staff. I keep thinking of it being his cleaner, but when I look at it, it's everybody on his staff that he paid a lower rate of tax.
So in terms of the Office and the where we're now, so it's sort of is it a political or an economical thing, really, in your view?
Well, simple numbers. The last recorded or full year's stats, capital gains tax raised £7.8 billion, which was just under 1.5% of total tax take. So I don't think you can really say it's economic.
A month's furlough as well, or something as well.
Probably not far off. So it's not economic. It's not going to raise huge amounts of money. Even the OTS, at the end of its reports, it says that aligning income tax rates could raise 14 billion, so triple the amount of capital gains tax. But it then immediately says, of course, that's not going to happen because behaviour will change. So it feels political. Half of 1% of the adult population pay capital gains tax. 60% of the population pay income tax. It's not difficult to work out which is the easier target.
Cool. So I've got three, I think maybe 4 questions coming up for you, Alastair. One about simplification or actually complexity. One about sort of how it might interact and some of the boundaries, and another about whether this whole thing could be fair or not. So just to kick off on the first one, obviously office of tax simplification. To many, capital gains tax, I know many haven't heard of it. Many might say it's a really simple tax. It's 20%. Yeah, true or false?
Sometimes is the answer. There are 4 rates currently of capital gains tax: 10, 18, 20, and 28, depending on who you are and what you're selling. There's actually a 5th rate that isn't mentioned because it's not a rate in itself. But if you happen to sell your business into an employee ownership trust, you pay 0% capital gains tax. But that's done because the gain is deferred. But for you, it's a 0% rate of tax. Yeah. So there are these 4 rates of tax. Is that really all that complicated? I'm not sure it really is. 2 of them are for basic rate taxpayers, and 2 are for higher rate taxpayers. And then you have the bad relief, what used to be entrepreneurs relief, which is also 10%. Yeah.
So probably far fewer rates of tax there. Capital gains tax and income tax, for example, which is I won't put you on the spot and ask you to count them, but there's a few of those kicking around, I suspect. So talking of income tax, in terms of sort of the overlap, and I think that I can sort of see where they're trying to get at, that there is an overlap between capital gains tax and income tax as such, where obviously the CGT rates are lower, and you touched on behaviours, and we'll talk about behaviours later, but obviously where there's a lower rate, people are going to try and turn income into capital,
which is long-standing. Capital gains tax was introduced in 1965. Before that, there was no tax on capital gains, and so a great deal of the tax case law that we spend our time reading predates capital gains tax because it's all about the capital income split. But life has got easier. More people can access share portfolios. And create an environment where they can take income or they can take capital. It's not quite on the boundary, but one of the issues that's being addressed is by the OTS is the annual exempt amount. Everybody who's not everybody who earns under £100,000 has a personal allowance of, I think it's 12,500 per year, which is tax-free income. Everybody has an annual exemption of 12,300 for capital gains. And one of the things that the OTS has pointed out is the volume of taxpayers who record capital gains of at or around the annual exemption. It's roughly 20% of the number who actually pay capital gains tax. So people are essentially creating 2 personal allowances each year.
Yeah.
Cool. So that is an issue, which is being looked at and creates perhaps a sense of unfairness.
Yeah.
But then you have issues such as carried interest in private equity type businesses, where there is a sense, whether it is right or it is wrong, there is a sense that some income is taxed as capital gains. The ability of company owners to sell some of their retained profits that they haven't paid out as dividends and receive a capital sum for it. There is the treatment of employee share ownership, and this is an interesting issue because there's a boundary issue between share-based remuneration, cash-based remuneration, unapproved share options, and something we see occasionally called growth shares, where you can get broadly the same economic outcome but get taxed in a fundamentally different way depending on which route you take. So there are a series of boundary issues there that do probably need to be looked at.
Cool. So to summarize, what the OTS are trying to do, they're trying to live by their name. They're trying to simplify CGT and maybe reduce the number, or recommend, because they can only recommend, can't they? They can't legislate. Recommend that CGT there gets a bit simpler. They want to look more closely at the boundaries to make sure that those who are taking advantage of those boundaries, it's realigned. and ultimately they want to try and make it fairer, and all in a backdrop of, so the political and economic one that we've got at the moment. So, Alastair, what overall have they found? Me, relative layman, it looks like they're trying to say, CGT should equal income tax. It keeps it really simple, and we can all move on. Is that what they're saying?
They're hinting, but not saying. There is only one recommendation, and that is to abolish a relief which virtually nobody uses. Everything else is that government should consider doing various things. It's proper building a fence and sitting on it.
You're not sceptical there of this fine panel that's been set up to write this 135-page report, Alastair?
I'm not sceptical of the panel, but I'm sceptical of what they've been asked to do. They have said that we should consider aligning or bringing closer to alignment income and capital gains tax rates. And that's been talked about a number of times, and was in fact the case from the late 1980s for about 10 years when Nigel Lawson aligned the rates. But alongside aligning rates, they've also suggested reviewing boundary issues where income and capital may look much the same. But they've also said that some of the reliefs that have gone over the last 20 years perhaps should be reinstated if rates are to be aligned. So an allowance for inflation, for instance, but also something new, saying that capital losses should be more flexible than they currently are. So there is scope there for a system which properly aligns income and capital, if that's the route that's taken.
Cool, brilliant. So, looking back at the paper, Alastair, you said there's one firm recommendation, but they have made several other areas where they have put something out there for the government to consider, and several of those are around entrepreneurs, and we've heard a lot about entrepreneurs are going to be the heart of the economy to grow us out of the potential financial mess that we find ourselves in. So with respect to entrepreneurs, what's the paper saying with this backdrop that possibly capital gains taxes might equal income taxes?
I think one key area is what's now called the BAD relief, but used to be called entrepreneurs relief, which was introduced by Gordon Brown. Oh, sorry, he didn't introduce entrepreneurs relief, but he brought business asset taper relief into existence, which then morphed into entrepreneurs relief, with a view to making a capital gains tax system that encouraged entrepreneurship, which flew in the face of Nigel Lawson's changes, which said income and capital were just the same thing. Now, there had always been something called retirement relief that allowed businessmen of a certain age to sell their businesses and for some part of any gain to be tax-free. So there always has been some form of relief for a businessman. And I think the OTS recognises that and says something should persist. Their view, though, is that it should be more closely linked to age, so going back towards a retirement relief, and the view that selling your business is akin to drawing down on your pension fund, which you may not have been able to create. Now that presents a whole series of issues, not the least of which is that many people are creating businesses when they're very young, which perhaps was not the case previously, and that those business, it's a fast moving economy with people spotting good quality businesses and wanting to buy them out, but not necessarily wanting to take the person with them that created it. So I think an age related relief for entrepreneurs is not going to produce the results that are desired by government.
And is that not an ageist thing to do? And can they deliver a relief for some? I know they probably do in other areas. For some, an entrepreneur who's 55 selling their business be different to a 45-year-old one it doesn't seem very fair to me, to be honest.
Well, I've flippantly said to you in the past that it sounds a bit like age discrimination, but as somebody who's fast approaching the age that they'd have in mind, it probably worries me less than you.
Fair enough, Alastair. And other things in there. I think that there are some specific things about, a recommendation at the moment. The bad relief is at 5% of the and hold it for a few years. I think they were firming up, or at least a recommendation they put in there to test the water was 25% as opposed to 5% being a proper level, and extending the number of years to holding it to, was it 10?
I think there is talk of a 10-year holding period, which takes you again back to taper relief. And once again, there's very little that's new.
Yeah.
In the life cycle of a tax.
Yeah. And I suppose if one, in a world where tax rates are likely to go, I take it as a big positive, though, that there is a fairly big chunk in this document about, they're very definitive thing about there should be reliefs for entrepreneurs, which I take as a positive. And just picking up, though, and we often talk about behaviours, Alastair. If they do push up the rates, for the CGT, do we think that people might stop selling their shares in their company, but they'll have a holding company that will then sell the shares, and pay a 19% corporation tax, and then sit on investment vehicles? Is that
there's an article, I think, in the Times today or yesterday, it will be the Sunday Times if it was yesterday, but saying that a change in capital gains tax rates, they were there referring to buy-to-let landlords. They would just change the way they behave and trade and carry on the activity through companies. It is exactly the same. The use of a holding company structure where that holding company should pay no capital gains tax on a disposal at all feels quite likely. We may also go back to the good old days of people going non-resident to realise their capital gains. It's more difficult than it was, but it's still possible. So it is the law of unintended consequences that needs to be considered. And so having a sensible relief fairly applied seems more sensible than creating an environment in which people will fundamentally change their behaviour.
Yeah. And the other bit that the paper draws out is the ability of the current entrepreneur to extract maybe some of their surplus assets by way of a capital realization as opposed to an income realization. Now let's assume, obviously, if capital gains tax and income taxes are the same, then it makes no difference which way you're getting at. But let's assume that that the capital for this section of the population is lower than income tax. That the paper's got some recommendations about what could happen to those surplus assets if and when they're extracted from a business in a disposal.
Yeah, and put simply, the suggestion is that retained profits that haven't been paid out by way of dividend would be taxed as though they were, well, they say income, but one assumes as dividend. And there are countries, I think Australia has a system which is broadly along those lines, so it's not kind of outlandish. And we have anti-avoidance legislation, which was designed to stop really the sale of retained earnings. Now there are safe harbour provisions where you sell all of your business, but the concept is one that we've had in our tax system for a very long time, and other nations have. And perhaps it doesn't seem unfair, if fairness is your aim, that you can't just keep building up cash and undeclared profits. I'm sorry, not undeclared, but undistributed profits, and sell them at a lower rate of tax. And of course, one of the tests for what was I think it was for taper relief, for business property relief, for inheritance tax, for entrepreneurs relief, is essentially the amount of non-business assets for which read cash, largely, that you have on your balance sheet. So there's plenty of precedent for these kind of tests. It's like everything, it's how they are applied. And the problem with this, as with many other things, is that if you have a nuanced approach to taxation rather than just a sledgehammer which says everything's taxed at income tax rates, nuance creates grey areas, it creates subjectivity and uncertainty for both taxpayers and for government. So how will a taxpayer, or indeed the revenue, know what is excess undistributed profit?
Yeah. And it's a subjective area, but I think the important for anybody watching this, and I think out of this paper I take there's a positive and a negative. I think the positive is that the entrepreneur has been singled out as somebody who is worthy of and deserves of relief, which could be good. And if I put my optimistic hat on, it might be that for a certain segment of entrepreneurs that their tax rate could be lower if some changes come through. I might be being a bit optimistic there. Stop smiling, Alastair. But at the same time, if they were to benefit from such relief, it's pretty unlikely that things like surplus assets would be able to scrape through on that relief. Is probably the direction that we might end up in.
I think that's absolutely right. I think almost, well, unless rates completely align, I think one can expect a great deal more focus on those boundary issues, of which retained profits is clearly one.
Yeah, brilliant. Another bit that the paper draws out is shares and share schemes, where at the moment it's very possible for employees to be benefiting for an increase in the capital value of the business they're working in and paying capital gains tax. What's sort of the paper's general take on whether that's an acceptable thing going forward?
I think the paper reflects the reality that it's a confused and I've used the word nuanced before, but a nuanced area. You have a stated policy aim of encouraging employee ownership and engagement, which has led to a range of steps. EMI share options being a key thing for many employees, but employee ownership trust, which we've also talked about briefly. But then you have the area of, well, hang on, employees could be paid in cash or they could be paid in shares, but if they get paid in shares with the upside that goes alongside that and the benefit that their work helps to generate, well, they get paid some of their remuneration as a capital gain. So the argument goes, and is that fair? Particularly when they may not actually be taking real economic risk, as in they may be putting very little in, and of them.
And that's one of the takeaways I sort of have from my is about risk, and capital gains tax should be there, or one of its theories is in theory a lower tax risk for someone who's taken a risk, lower tax rate for someone who's taken a risk by investing something into a business, whereas an EMI scheme, typically the employee's not investing much other than their time, effort and energy, which usually equates to income.
Yes, and perhaps even more extreme than EMI, we touched on growth shares. Yeah. Growth shares are something we use, I guess, typically where we can no longer use an EMI share option. And there you have something with the same economic outturn as an unapproved share option where the whole gain will be taxed as income, but created into a share bought outright for a relatively low price, where the whole outturn comes out as capital gain under the current rules. And there again is that tension, and what risk, the question is being asked is, what risk is the employee really taking as other than the opportunity cost of, well, I could have earned more somewhere else.
Yeah, but that is it's like many of our clients and many entrepreneurs and many employees, especially in the the scale up businesses where people do take a risk. They leave their job in a large secure corporate to go and participate in a smaller entrepreneurial business where the reward could be very good, if that risk pays off. But if that entrepreneurial business was to pay them their full salary on day one, that entrepreneurial business wouldn't get off the ground in the first place. So,
and there you have the problem. There you have precisely why you have a government trying to encourage employee participation, because it's good for the economy. And as has been said any number of times, it's going to be the entrepreneurs that get us out of the economic mess that we're in at the moment. But that there isn't that measured capital at risk, which is, I guess, at the heart of how many people view the capital gains tax system as it should operate. And that is, I think, it's one of the areas where the OTS has a real problem, because how does it recommend something which is a government policy? It's designed for a different purpose.
Yeah. And so obviously, if income tax does equal capital gains tax or vice versa, then this is a non-conversation, because it doesn't really matter. But in reality, if we were in a world where the rates stay the same, would you say the writing is on the metaphorical wall for employee share schemes and capital treatment?
No, I think for approved schemes, they're so embedded in government policy that I think that they will survive. I think there will be steps taken, perhaps, to look at something like growth shares, but it feels like quite a difficult step to address.
Yeah,
because you are requiring something with a known value. What you might have, I suppose, is a review of the way share options and shares generally are valued, and whether the minority discounts and the like that are applied in the valuation are indeed appropriate. But that's guessing, nothing more.
Yeah. So, Alistair, we just had a chat through sort of the OTS paper that's just come out about simplifying the capital gains tax world, and some of the pros and cons and some of the things that may or may not happen. So what's your view on whether any of these things actually will happen or not?
Oh, there, my crystal ball, as ever. There's been something of a pushback already in the press on changes to capital gains tax, and this does feel a little bit like it's the pre-budget kite flying to find out what might be acceptable and what might not be acceptable. So do I think all of this is going to happen? I don't think so. I mean, it's huge changes, certainly for a budget in only 3 months' time. Over time, it is possible, but it's quite a big change back for capital gains tax. Could there be some increase in rates? Yes, I think there probably could be. But again, economists seem to be saying do not make tax rate increases now. Save it for a few years. So it's always impossible to say what may or may not happen. But with the pushback and the economic news, I don't feel like significant change at the moment. But how often am I right about things like that?
So finally, so if you fall into a camp where actually you're worried that there is going to be some significant change in March, is there any planning or anything that anyone can realistically do to try and take advantage of today's rates?
Well, if you're going to try and take advantage of today's rates, you need to transact and properly transact, rather than put something in place which allows you to keep control, which allows you to only pay the tax if the rates do actually go up. When the entrepreneurs relief lifetime limit was cut from 10 million to £1 million, there were some very strong anti-forestalling measures put in place, which will, I suspect, be put in place if there are significant rate changes, to ensure that The old transactions benefited from the old lifetime limit. So trying to be too clever, I suspect, will come back and bite you.
Cool, brilliant. No, so thanks ever so much for all of that, Alastair. So I think the summary from Alastair is that could be change afoot, might not happen in March, but if you think it's going to happen in March, sadly, there's probably not a lot that you can do other than transacting properly to lock in today's rates. So thank you very much, Alastair. We look forward to our next session when there's a further update on capital gains taxes.
Thanks, Matt.